Hey everyone, Mark Ferguson with Invest for More. I'd like to welcome you to another one of my real estate investing videos. Today I'm going to talk about the housing market, the possibility of a crash like we saw 10 years ago. There's a lot of rumors out there, people saying there will be one. And I want to talk about the likelihood of it, what factors to look at, what our current market conditions are like compared to pre-crash in the early 2000s, and hopefully help you out, shed some light on my thoughts about the market. So before we get started, of course, check out investmore.com. I've got over 450 free articles, my weekly podcast, also my awesome YouTube channel that you're on right now. So you're always welcome to comment here, ask me any questions you want, and you can email me to mark@investformore.com. All right, so the housing market crash. I see things on Facebook, blog sites all the time about how we're in a housing bubble, how prices are too high, and how things are going to come crashing down soon. Now, I don't exactly believe all of that, and there's a number of reasons why I don't believe that's going to happen. But we have to look at a number of factors. First, real estate is very local. So even in the previous housing crash, it wasn't like the entire United States saw prices cut in half. There were places like Phoenix, California, Las Vegas that saw incredible, huge, price drops. They lost 70% of their value, 80% of their value. It was insane. Other places, like the Midwest, saw maybe a 10% decrease, a 20% decrease. Other places didn't see any decrease at all. It's very local specific how real estate prices react. So you can't just assume that your market's going to act like every other market in the US. And if housing prices are too high in California, that's going to make your prices in St. Louis crash. You have to look at real estate from a local perspective. And I'll show you how to do that, at least help you get an idea of what your market looks like in this video. Something else to consider is that just because prices are high, that does not mean we're in a bubble and they're going to come crashing down. If you look at the graphs that show the housing price index in the United States, we are not that much higher from the historic average. What happened was we had a huge jump in prices in the early 2000s, mostly due to really bad lending policies and an overabundance of house building. And we saw a huge crash because people realized how horrible those loans were. They began to foreclose, and we saw prices plummet. Well, prices have jumped back up again, but it's been over a 10, 15-year span that prices have been going up. And because we had such a huge crash, prices are not that much higher than what the historic average should be. There's a lot of places like Florida, Phoenix, where prices still aren't as high as they were pre-crash. So just because prices are higher does not mean they're going to come back down. Now, I'm not saying that they're always going to go up forever. Obviously, there will be ups and downs and prices can drop, but that's not a reason for them to drop. Just because they're high, you've got to have more data, more things to look at than the house prices. And something else you can look at is the lending guidelines. So a lot of people I see, also on Facebook, are talking about subprime loans are back, no money down loans are back. Okay, here it's all happening again. The whole market's going to come crashing down. We're all doomed. Well, yes, there are low money down loans available. There have been low and no money down loans available for decades, way before the housing crash, even during the housing crash, and after the housing crash. It's nothing new. It's not like this happened right before the housing crash is some new thing, and then they went away and they came back again. They've been around forever. The government has backed low money down loans for a very long time. Private mortgage insurance, private mortgage companies allow you to get low money down loans and have been for decades. This is not a reason to panic. They've always been around. The government wants people to buy houses, and that's one way they do it. Something else, subprime loans. Subprime loans means that the borrowers have not very good credit. So usually the guideline is if your credit is below 620 to 650, it could be a subprime loan. So there's people who are saying, hey, we'll give loans to people with 600 credit scores or even 580. And people are saying, oh man, subprime's back. We're all doomed. The market's going to crash. There are all these bad loans coming. But something you have to think about is just because those loans are available does not mean they're actually happening. So I've got some stats here. Before the crash, there's $620 billion in subprime loans written. Right now, 5 billion. That's a decrease of 90%. There's 90% less subprime loans than there was before the crash. Yes, they're available, but banks are not giving them out like they were before the crash. It's just not happening. Something else to look at, the average credit score now is 740 for people buying a house. That's incredibly solid. Even in 2009, which was during the crash, it was 686 for an average credit score, and way lower than that pre-crash. So credit scores are way higher now than they were before. And then one thing that's really interesting, the lowest 1% of loans, as far as credit scores go, is about 620 right now. So the worst 1% of people getting a loan have a credit score around 620, which is not amazing, but it's still not bad. You know, many people have credit scores in the 600s and make all their payments and do just fine. Before the crash in 2001, the lowest 1% of people getting loans had a credit score of 500, 120 points lower. So think about that. If you think the lending guidelines are even close to as loose as they were before the crash, it's simply not true. Lending guidelines are much better, much stronger. Credit scores are higher. Loans are much more solid. So just because prices are high, just because there's some loans available out there, doesn't mean we're going to have a housing crash. Lending is way stronger than it was. And something else to really look at is why the crash happened in the first place. Mostly because of bad lending guidelines. I was a real estate agent, investor, starting in 2001, 2002. I went through the housing crash in Colorado. We did not get it as bad as some people, but we saw prices drop in some neighborhoods 60, 70%. Other neighborhoods we saw 10 or 20% drop. But we saw some pretty big drops. And before the crash, you know, I talked with my dad, who's an agent as well. I'd be like, what's going on? Why are banks giving out these loans? It doesn't make any sense. I was seeing 120% loan to value ratio loans, huge seconds, low interest rates on people with bad credit. It just did not make sense, the loans they're giving out. And a lot of people saw the same thing, but didn't really think much about it, just thinking, oh, it's fine, it's housing, prices will always go up. Well, because everybody was getting a loan, we saw that incredibly low credit scores some people had. There were stated income loans where people did not have to even verify their income. They just basically said, yeah, I make $100,000 a year. You're not going to check it, right? I'm like, no, we don't need to check it. You say it. That's good. Cool. So there's your loan. And because so many people could get a loan, they're buying multiple houses. Prices kept going up. Everybody's happy. Then the builders came in and just started building like crazy. In Florida, in Phoenix, in California, Las Vegas, in Colorado, they built a ton. And they built and built and built. And eventually, everything came tumbling down. And what happened was, people couldn't afford those loans. They're lying about their income. You know, once you buy a couple of houses, it's not as easy to rent them out or, you know, have them make money as it may appear. People were over leveraged. They're getting armed, so they have a real small payment in the beginning, which would raise in 6 months or a year, which is just crazy. All types of things happen. And then once things started to crumble a little bit, people looked at these loans and said, oh man, these are horrible loans. These people have horrible credit, as we saw. They don't have any income. And the foreclosures started. And once the foreclosures started, they kept going. Because they had built so many houses, there weren't enough people to live in them. People were buying multiple houses, and there was thousands and thousands of vacant houses around. The only way to sell them was for prices to just drop incredible amounts, where people are like, oh my gosh, it's just stupid not to buy this house for $100,000 that used to be $300,000. Everything changed during the housing crisis. Everything got stricter on loans. It got to a point where it's really hard to even get a loan, and things changed. Now, we've already shown lending guidelines are much stronger than they were before. But the other factor you have to look at is, why are housing prices higher? And the main reason is low supply. Before the crash, it was a false demand created by everybody being able to get a loan that created prices to jump. Now, that demand is not false. People who can buy a house, who should buy a house, still want to buy a house. But there's almost no houses to buy because it's gotten so much harder to build after the housing crisis. It was much easier for big builders to get loans, to get financing before the crisis. Now everyone's scared to give one builder too much money. They don't want to see him crash. A lot of banks got destroyed by funding big builders who went bankrupt in the crash. Some went under, in fact. So what we're seeing now is pre-crash, in 2005, there were 1.28 million new houses built. All-time record. Now, 2015, 500,000 houses are being built. That's what was being built like 4 decades ago. But the population has increased over that time. There's more people who want to buy houses. There just simply aren't enough houses out there being built. So the only thing that can happen is prices go up. If there aren't enough houses for the people who want to buy them, people pay more money, and prices go up. Again, we talked about housing prices going up is not the only factor to predict a crash. It can, have indications that things will change. But it's a completely different situation than it was before the crash. Now, I'm not saying we're not going to see prices drop or things, change. Colorado has seen incredible price increases, 200% in some cases. It's just crazy how high prices have gotten. California, other places are the same way. But there's demand and supply issues that are causing that. It's really hard to build in Colorado. Water is super expensive. There's not a whole lot of cheap land available, so prices have to go up. Same thing in California. Other places where water is cheaper, there's more land, it's less expensive to build. Prices don't go up quite as high. Well, there's all kinds of factors you have to consider in your own local market. So what I've looked at in Colorado, and this is how I think you should look at your market too, to try and figure out, hey, things are going to go up, they're going to go down, what's it look like? Again, I can't predict this for sure, but it can give me an idea, is supply and demand. If there's really low supply in your market, it's going to be tough for there to be a housing crash unless something drastic happens across the country or in your local area, because there's simply not a lot of houses that can flood the market, which is what caused the crash last time. What's the economy look like? Our economy in Colorado has like a 2.8% unemployment rate. Tons of people are moving in. There's tons of jobs. Things look really well on that front. Again, that could all change, but for right now, it looks pretty good. Same thing in other states. They have really strong economies. Are people moving into your area or moving out? That's one thing I really like to look at. If people are leaving your area, that could be a very bad sign for housing prices. That means they could drop because you'll have too many houses for the people who want to buy. But if people are moving in and they aren't building enough houses for those people, prices will probably keep going up. Now, the one thing you have to consider, or a couple of things you have to consider in this, is affordability. Can people afford the housing prices in your area? Colorado is getting very expensive. People make decent money here, but not as much as they make in, say, California. But they're still buying houses. They're figuring out ways to buy houses. If prices get too high, that could be an issue. There might not be enough people who can afford houses. Things could level out, start to drop a little. Same thing in California, Seattle, other places. There's all kinds of things that could happen. Another thing are government policies. Trump wants to change some tax plans, change the capital gains waiver from 2 years to 5 years, which means you have to stay in a house for 5 years before you don't have to pay capital gains on the profit. Mortgage deduction could be changed. There's all kinds of things could change. Could that cause a housing crash? I doubt it, but it could cause the market to slow down, even drop slightly. A lot of people all of a sudden might want to sell their house to take advantage of the old laws, and so they don't have to wait 5 years for the new laws to, take a tax-free profit. And something else is, of course, the national economy. We don't know what's going to happen as far as interest rates, unemployment, the debt. There's all types of things could affect us. Now, a recession could definitely hurt the housing market. Do I think it's going to destroy it? No, but we could see a leveling off, a drop. And something else I think you have to consider is, I'm a real estate investor. I'm an agent. I went through the last crash. Prices dropped a lot before people felt comfortable buying again. As a real estate investor, there are thousands of investors and billions of dollars in investor money and hedge fund money waiting to jump into the real estate market if prices drop. I don't think investors will ever let it drop as hard as it did before, because once prices start going down again, those hedge funds, those investors who've been waiting for a drop, will jump into the game, start buying those houses, and keep the bottom from hitting as hard as it did. So there's a lot of things to consider. My opinion is prices could keep going up. They could level out. They could drop a little. I do not see a huge crash. I don't see a huge jump in prices like we've had before, but I've said that the last 2 years and been wrong. So again, I try not to predict that stuff. Just try and give my best guess and plan accordingly. When I invest and buy properties, I try to invest for today's prices. I don't ever assume they're going to appreciate in value. My rentals, I want them to cash flow now. My fix and flips, which I have 21 of right now at the moment, I want them to make money in today's market and have plenty of room and profit in case things drop. So plan for the worst, hope for the best has always been my motto. And if you're one of those people kind of sitting on the sidelines, waiting for another crash to jump in, maybe it'll happen. But again, you have to consider some things. What happens if the crash never comes, if prices just drop a little? How are you going to know when the bottom is? If things do start to drop a bunch, are you going to jump in sooner, later? There's some things to figure out. It's really easy to invest in hindsight and say, oh, I wish I would have bought 100 houses in 2011 when prices were at the bottom. Well, nobody knew that was the bottom in 2011. A lot of people thought it was going to get way worse and keep dropping. A lot of people in 2012 and 2013 thought we were going to see a double dip and prices were going to drop even harder than they did before, but they just kept going up. So there's a lot of things to consider about the housing market, what prices will do. I always say, look at your local market, try and figure out as much as you can there. Plan for the worst, hope for the best, but I don't try to predict things. I try to invest for today's market. Hopefully they go up, and if they don't, hopefully I've planned well enough that I'm safe and can make it through any downturns. All right, thanks for watching. Hope you enjoyed the video. Please give me a thumbs up if you did. If you want to subscribe and see all my before and after fix and flip projects, they're coming up weekly. And check out investformore.com if you want to read some more articles or check out my podcast. Thanks a lot. Have a great day.